Most people start their passive income journey at level 1, and you are probably there right now. This is the realm of simple cash flowing assets that require almost no effort to maintain once you set them up. Think high yield savings accounts, certificates of deposit, or treasury bonds. You are essentially lending your money to a bank or the government, and in return, they pay you a small but predictable interest payment every month. The returns are modest, usually between 4 and 5% annually in a healthy economy. But the beauty is in the simplicity. There is no learning curve, no risk of losing your principal in a market crash, and no need to study financial statements at night. You can open an account in 15 minutes and start earning interest the same day. The downside is inflation. If your savings account pays 4% and inflation runs at 3%, your real return is only 1%. You are not building wealth, you are simply preserving it. But level 1 is not meant to build wealth. It is meant to teach you the foundational habit of making your money work for you instead of sitting idle in a checking account earning nothing. The psychological shift that happens here is more important than the dollars involved. Once you see that interest can land in your account without you lifting a finger, your brain starts to look for the next rung on the ladder. That curiosity is what pulls you upward. At level 2, you graduate from being a lender to being a part owner of real businesses. Dividend stocks pay you a portion of company profits every quarter, and broad market index funds give you a slice of hundreds of companies at once. You buy shares of a company, and every 3 months, they send you a check. Some companies have raised their dividends every single year for 50 consecutive years, creating a reliable income stream that grows faster than inflation. The advantage over level 1 is twofold. First, your capital has the potential to appreciate over time, meaning your original investment grows in value on top of the dividends you collect. Second, reinvesting those dividends compounds your returns dramatically. A modest monthly contribution over 30 years can snowball into a portfolio worth millions, even if you never earn a paycheck from it. The risk profile is moderate. Markets fluctuate, and a bad year can see your portfolio drop 20 or 30%. But over decades, the trajectory of productive businesses has always been upward. The discipline required is to keep buying through the crashes, not to panic and sell at the bottom. Now, we enter the territory where passive income starts to feel substantial. A single family rental, a duplex, or a small apartment building can generate hundreds or thousands of dollars per month in cash flow after expenses. Unlike stocks, real estate lets you borrow most of the purchase price, meaning your out of pocket dollars control a much larger asset. The math works because of leverage. If you put $20,000 down on a $200,000 property and it rents for $1,500 a month while your mortgage and expenses total $1,000, you are earning $500 monthly on a $20,000 investment. That is a 30% annualized return on your actual cash, far above what any savings account can offer. The catch is involvement. Being a landlord means answering phone calls about broken water heaters at midnight and chasing late rent payments. True, passive real estate usually comes through syndications or turnkey providers, where a professional team handles operations and you simply collect distributions. Real estate also offers powerful tax advantages. Depreciation can shelter a large portion of your rental income from taxes, and a 1031 exchange lets you roll profits from one property into another without paying capital gains. These benefits are not available to stock investors, which is why many millionaires keep the majority of their net worth in property. While stocks and real estate get most of the attention, sophisticated investors build bond ladders to create predictable streams of cash. A bond ladder means you buy bonds that mature at staggered intervals, say 1 through 5 years out. As each bond matures, you receive the full principal back plus the interest earned, and you reinvest the proceeds into a new long-term bond at the top of the ladder. The result is a portfolio that hands you cash on a known schedule, perfect for retirees who want to draw income without worrying about market volatility. You can know on January 1st exactly how much money will land in your account each month of the year. Corporate bonds from strong companies can pay 5 to 7% with relatively low default risk, and municipal bonds offer tax-free income that competes with higher-yielding taxable alternatives. The limitation is that bond ladders require meaningful capital to generate meaningful income. You need hundreds of thousands of dollars to produce enough cash flow to replace a paycheck, which is why bond ladders are usually a level 4 tool rather than a starting point. This is where creators and inventors build generational wealth. Royalties are payments you receive every time someone uses something you created. Songwriters receive a royalty every time their music is played on the radio. Authors receive royalties every time their book is sold. Software developers receive royalties from App Store purchases of their code. The economics are extraordinary. A song that takes a year to write can pay you for the next 70 years, plus, with zero additional effort. A book can pay you for the rest of your life and then pass that income stream to your children. A piece of software can serve customers for decades, generating revenue while you sleep. The challenge is the front end. 99% of songs earn nothing, 99% of books sell fewer than 1,000 copies, and 99% of apps are deleted within a week. The ones that do break through, however, can produce 6 or 7 figures of passive income over their lifetime. The modern creator economy has lowered the barrier to entry. A musician with a laptop can distribute globally through streaming services. A writer with a blog can reach millions through search engines. An educator with a camera can build a library of courses that sell themselves for years. At level 6, you stop creating individual products and start building systems. An automated online business might be a portfolio of niche websites that earn advertising revenue, a dropshipping store that runs without inventory, or a software as a service tool that bills customers monthly. The common thread is that once the system is built, it operates with minimal human intervention. Content websites are a perfect example. You write 100 articles targeting specific search queries, optimize them for search engines, and let the traffic roll in. Each article earns money every month from ads or affiliate links, and the cumulative effect of 100 revenue-generating pages can produce a full-time income with no ongoing work. The keyword is systems. Every task that needs to happen regularly should be handled by software or outsourced. Email sequences run on autopilot. Customer service is handled by a virtual assistant. Content updates are scheduled in advance. You become the architect rather than the operator. The investment required is usually time rather than money. You might spend a year building the system before the income becomes meaningful, but once the flywheel is spinning, it can run for years with only minor maintenance. If you have created something that works, you can let other people pay you for the privilege of copying it. Licensing means you grant permission for someone else to use your intellectual property in exchange for ongoing fees. Franchising means you package your entire business model and sell that package to operators who run locations under your name. Both models share a powerful characteristic. You expand without spending your own capital or your own time. A hotel franchise with 500 locations does not require the founder to operate any of them. The income is highly scalable because your marginal cost of producing another license is essentially zero. The catch is that you need to have built something worth licensing in the first place. Most people never reach this level because they never create an asset valuable enough that others will pay to replicate it. At level 8, you stop being an investor in public markets and start owning pieces of private businesses. You might buy a small business outright, invest in a private equity fund, or partner with operators who run companies you partially own. The income comes from profit distributions rather than dividends, and the returns can be substantially higher than anything available through public stock markets. Owning a private business is the ultimate form of passive income because a well run company prints cash every single day. If you structure it correctly, you hire professional managers to run the operations, install a board to oversee them, and step into the role of investor rather than operator. You attend quarterly meetings, review financial statements, and make strategic decisions. But the day to day work happens without your involvement. The capital requirements are significant. Buying even a small business usually requires hundreds of thousands of dollars, and meaningful private equity portfolios require millions. This is where generational wealth truly begins to compound. The risk is also higher. Private businesses can fail, and unlike public stocks, there is no liquid market where you can sell your shares in an emergency. You are locked in until the business either succeeds, fails, or finds a buyer. Due diligence becomes critical, and access to quality deal flow usually requires a network that takes years to build. Level 9 is where your name itself becomes an asset. Authors, speakers, consultants, and public figures eventually reach a point where their personal brand commands fees simply by existing. A thought leader with a strong reputation can charge premium prices for a 1 hour keynote speech. An expert with a recognizable name can launch a product and sell thousands of copies on day one purely based on the weight of their identity. The passive component comes from the gravitational pull of reputation. Book sales continue because of who wrote the book. Course sales continue because of who teaches the course. Partnership offers arrive because of who you are. You are no longer trading hours for dollars. You are leveraging the accumulated credibility of a lifetime of work. Building to level 9 usually requires decades of consistent output. Reputation cannot be hacked or bought. It must be earned through repeated demonstrations of expertise, integrity, and value creation. But once it is built, it compounds like financial capital, opening doors that are closed to everyone else. Level 10 is where all the previous levels converge into a self reinforcing system. The investor who has reached this level typically holds diversified streams across multiple categories. They own dividend paying equities, cash flowing real estate, royalty producing intellectual property, and private equity stakes in operating businesses. Each stream feeds the others. Income from one asset is reinvested into the next. The whole system grows faster than any single component could alone. The defining feature is optionality. At this stage, you have enough passive income to cover every expense in your life many times over, which means you can work only on projects that genuinely interest you. You can take risks that might fail without threatening your lifestyle. Money has become a tool rather than a goal. Reaching level 10 usually requires a combination of high income in your working years, disciplined saving and investing, decades of patience, and a willingness to defer gratification. Most people never get there, not because it is mathematically impossible, but because they lose focus along the way or spend their capital on consumption instead of acquisition. The good news is that every single level is open to anyone willing to climb. You do not need to reach level 10 to transform your life. Moving from level 1 to level 2 already changes your relationship with money. Moving to level 3 or 4 begins to provide real freedom. Each rung adds another layer of resilience, another source of income that does not require your time, and another step toward the kind of life where work becomes a choice rather than an obligation.